So after a weekend in the sun, I'm back, and I want to talk about moving averages. I want to talk in this video about what moving averages are, what everybody else uses, what I use in my trading, and how to scan for them. So let's not waste any more time. Let's get going. Hey everybody, Tom Gentile. Welcome to Tom's Trading Room. You know what we do here. We show you how to spot rules-based opportunities and create alternative risk trades other than simply buying and going long. Do me a favor right now. If you've never seen anything like this before, help us out. Hit that like button. It helps support the channel. Also, by hitting subscribe and dinging the bell, you'll get videos like this every single week. Now, moving averages. All right, we got to talk about the ones that everybody else uses, the ones I use, and how to scan for them. So let's get over here on the computer and let's get to work. And quickly before I begin, let me just mention this disclaimer. You can pause this and read it in its entirety. I'm going to mention two quick things. Number one, stock and options trading has large potential rewards, but also large potential risk. And number two, I'm not an investment advisor. I'm here to show you how I spot opportunity and create alternative risk trades other than simply buying and going long stocks. All right, so the topic of today is moving averages. And like I said, I want to talk about the different types of moving averages and how I use them, how I scan them. But the most important thing first is, what is a moving average crossover? So a moving average is when you take a group of, let's say, closing prices of certain X number of days back. You add them up, divide by the number of days, and you have an average. Move forward, and you create a moving average that you can view on your screen. A moving average crossover is when you use two different time frames of moving averages. The shorter term is going to be more reactive to the stock than the longer term moving average. And over the long term, as these gyrate up and down, these two moving average lines will cross and actually create interesting buying and selling opportunities. Now, the most popular one that's out there, if you listen to mainstream media, is the golden cross and the death cross. The golden cross utilizes the 50-day and the 200-day moving average, and when the 50 crosses above the 200-day, that is a buying opportunity. The death cross is exactly the opposite. It's when the 50-day simple moving average, and these are SMAs, crosses below a 200-day moving average. That is considered to be the death cross, and it's time for the market to move lower. Now, you can utilize these in lots of software, including our tools. It would look something like this. So, most recently, the last golden cross that happened on SPY, which is the S&P 500 ETF, happened back in 2019, toward the end of 2019, when the S&P or SPY was trading around 315. Since then, what has happened? Well, we've seen that 50-day moving average actually separate from the 200-day moving average as the market's gone higher and higher still. We're now up over 100 points since that cross began. So you can see it's definitely a great long-term indicator when you're using it to ride trends. Also, you know, for example, a death cross would be when the 50 crosses below the 200, as you can see here with Suncor Energy. This was back several years ago, but it still works just as well today. Now, although this is a very popular moving average crossover, it's not one that I use, especially as a trader. The biggest reason why is it takes too long for these two moving averages to cross, given the length of each moving average, 50 and 200 day. I like the more tradable one, which is the 10-30 cross, where I like to be bullish when a 10-day crosses above a 30-day simple moving average, and bearish or go to cash when a 10-day simple moving average crosses below a 30-day simple moving average. It would look like this. On this chart, we see, in the case that we're looking at here, where we see two sell signals and a buy signal, which basically indicate that there was a couple of different places you could get short and long this one security. Imagine if it happens with one security, how many it would happen to over time. Well, let's take a look at it. So I'm going to move over to my tools, and I want to show you how we can scan these opportunities. So to scan them, I'm going to go and I'm going to jump over to my Moving Average Crossovers tab in Tom's Option Tools. And here I simply set the moving average, all right, 30 for the long, 10 for the short, and I'm going to use the S&P 500 optional stocks. Now, once I get this all set up, it's just a matter of clicking on the search button, and the search button will reveal to me stocks that are in the moving average bullish situation. I also see in the S&P 500 stocks that are in a bearish setup for today, and that's either a bearish stop, which means that we go to cash, or if you like these to the downside, perhaps you could put on a bearish strategy other than simply shorting these stocks. All right, let's take a look at these top 6 stocks on the board right here. So I see in order, and we got to look and see what order they're actually in: Comcast, DuPont, Hess, Carnival, Devon Energy, and Marathon Oil. These are the 6 stocks that are crossing as of this video. And what I see here is I see their stock trade. I see some ideas on the opportunities that could go along with them using the May options. I really think that I like to go longer term than these, so these I just look at but really discount. This column right here is called Slippage. Very, very interesting, because the higher this number is, the wider the difference is between the bid and the offer on the options. All right, implied volatility rank goes between 0 and 100, and what that tells me is that basically the lower this number is, the cheaper the options are relative to time to where they were in the last year. So when I see this top one, which is Comcast, and I see that volatility at a 5, that means it's at the 5% mark, being 0 being the lowest and 100 being the highest in terms of option premium. So I like that. In fact, anything under a 50 is considered a value, and everything you see here today is a value. But we're talking about numbers like 5.0. Look at Hess. Hess is showing an IV factor of 2.9. Carnival, 2.4. All right, so these three of these 6 here are in some really low numbers in terms of time premium. That means that call options or call spreads may be very interesting to look at going forward. Next is the delta. These are all in the 50s. This just tells me that the options that the software pulled, which are ideas, are close to at the money. All right. So if you look at the stock price, 56.80. Look over here, 56.50. That's pretty close to the money. 78.55, 77.50, 76, 75.50. So all the option strikes are very close to their stocks that we see here on board. That delta just confirms this. The final column that I'm looking at really helps me out in determining which one that stocks need to move the smallest move to get a double on the option. And that's how this is ranked, by percent to double. The lower this number, the less the stock needs to move as a percentage for the option to theoretically double in value. So as you can see here, Comcast, all right, we need a 3.7% move in Comcast for these May at-the-money calls to double in value. If you come down to the bottom, Marathon Oil, I need a 10%, a better than 10% move in the stock in order for this option to theoretically double in value. So this is a very, very unique and valuable tool to the option trader when it comes to finding the right option to pick. All right, so moving on. So if I were to look at, for instance, if I want to look at these and see what they've done in the past. So CMCSA, I'm going to click on it, and it's going to show me the chart of Comcast. And I can see in the past these buying opportunities. Here's a buy at below 48. Here's a sell at 52. Here's a buy and a sell that a small loss. Here's a buy that happened just above 50, and here's a sell that happened around the 55 area, and a buy that came just recently after earnings that could propel Comcast to new highs, bettering the highs of the year that were in mid-March. I can do that with every single one of these stocks. And then finally, it's a matter of looking at this information one more time and getting an idea of what option strategy works best for you. So that's how we, again, look at, evaluate, and scan this particular type of strategy using tomsoptiontools.com. In summary, stocks will come and go with this system as the stocks slow down. We find that they don't work as well, when stocks move very, very little from high to low. So I really like stocks that move about 2 times the market. That's a 2 beta stock, as they're more likely to swing. all right, both up and down. And while this is not a guarantee, it is one of many patterns that you could consider adding to your trading arsenal. I know that I do. Hey, thanks again for watching the video. 3 things for you. Number 1, for more information on how we trade like rules-based traders, check out the description below this video. I've got a lot of free stuff there for you. Number 2, like this video, please. It helps support the channel. And finally, if you subscribe to the video and ding the button next to it, you'll get the next one as soon as it's uploaded. Thanks again. We'll see you on the next video.